And now let's hand over to Merli Margaret Baroudi from the Multilateral Investment Guarantee Agency. I was going to make a really bad joke about the acronym for that, but I've decided I'll just leave that hanging.
Well, I guess for me, that's a question in the cocktail period. So I would just like to say first, thank you very much for the opportunity to be here today. It's a pleasure to join this conference and be able to share with you some of the work that we're doing at the World Bank and the overall World Bank group of which MIGA is a part on the global economy and economic prospects. So this presentation, I hope, will address 4 questions. How is the health of the global economy? Are there reasons for optimism? And can the optimism be sustained? And what policies could help? And because it's getting late in the day here, I'm not going to give you the answers until the end to keep your attention. But perhaps some of the other speakers have already provided some of the answers. But nonetheless, I will proceed. So how is the health of the global economy? Well, right now, the World Bank is looking at the global economy as being in a fairly robust global growth period. We're seeing a fairly broad-based cyclical recovery, which is underway at the present time. This is really being aided by a rebound in investment and a rebound in trade. And it's taking place against a very relatively, anyway, accommodative policy background, relatively benign financing conditions, improved confidence, and the sort of dissipating impact of the previous commodity price collapse. So as you can see here, we are projecting overall world growth to be in the range of 3.2% this year and 3% next year. This is going to be held in part through the continued recovery in the advanced economies, where we are seeing continued positive growth prospects for the euro area, for Japan, and also for the US, helped by expansionary fiscal policies. Growth in emerging markets is also picking up, and this is in part a reflection of the continued strong growth in emerging Asia, as well as improved prospects for commodity exporters after the 3 years of very weak economic activity that it's experienced and which many have seen very difficult and challenging circumstances with which they've had to respond with a very different policy set than they had previously. Nonetheless, there's considerable variation, as you can see here. So East Asia and the Pacific and South Asia, these are areas where we're seeing strong growth, helped by the powerhouses of China and India. In Europe and Central Asia, we see growth moderating a bit, although still supported by a favorable external environment. Latin America and the Caribbean, here we're expecting to see a growth pickup, helped by the swing in commodity prices, as well as some other elements of the political cycle that should help bring this part of the globe somewhat back from the very challenging period they've experienced over 2016 and 2017. Middle East and North Africa also seeing stronger growth prospects, helped by higher oil prices, obviously, but also some offsets from what could be a stronger growth performance as a result of the need to continue to adjust policies as they've experienced quite a difficult period given the collapse in oil prices that we saw. And then Sub-Saharan Africa seeing stronger growth, but still perhaps below what we would want to see going forward. So that's a sort of summary of what we're seeing. Robust global growth, but regional performance is varying quite a bit. So looking down a bit into what's driving the global growth forecasts, we see that global trade has really come back strongly. And from this first chart on the left-hand side, you can see that really over the 2017 and 2018 period, we've seen global growth climbing back virtually to the average that we had during the 2000 to 2018 the 2000 to 2008 average period. So that's quite a strong performance, perhaps was not fully anticipated. And that really has been driven by a cyclical recovery in manufacturing and investment growth. And that has really helped underpin the commodity price upswing that we've seen both in energy prices and in metal prices. And this has really driven part of the recovery that we're seeing in growth in the emerging market economies, and as well as global growth overall. So a relatively positive picture since mid-2016, coming from trade, commodity markets, and overall spilling into a positive outlook for the global economy. Now, when we look at growth in the advanced economies, we've seen that labor markets are tightening significantly. There's tightening in the US, in Japan, and the Euro area. So this is certainly a very pronounced development in these economies, and one that we're watching very closely. Now, when we look at this actual and potential growth in 2018 and 2019, we see that according to our modeling, which is detailed here quite a bit if you like the details, and of course if you have any questions on some of the details of these relatively complex slides here, please let me know, and I'm happy to help you with that. But essentially, we see these economies essentially performing very close to, or actually beyond their potential growth in the 2018 to 2019 period. And this you can see in the right-hand panel, where we essentially see the advanced economies basically in a positive output gap, meaning basically their economies are above their sustainable levels. That's where we see these based on our own forecasts. So then, if we turn to growth in emerging markets and developing economies, we see that we are seeing some rebound in growth in emerging markets and developing economies in 2018 and into 2019 and 2020. And this growth impulse can really be divided very easily into the commodity exporters in emerging market and developing economies versus the commodity importers. And with the commodity importers, we can see that GDP growth is relatively strong, but not growing beyond what we see in this chart at around 6%. But the emerging market and developing economy commodity exporters are finally seeing quite a strong pickup in their GDP growth. And this is reflected in their actual and potential growth in 2018 and 2019, again, according to our models, where we see continuing slack in the commodity exporters, but with the commodity importers essentially basically at their growth potential, with some slack overall for the overall group of emerging markets and developing economies. And essentially, just for added information here, the commodity exporters represent about 2/3 of the countries in this particular category. So if we look at the output gaps over time that is shown in this right-hand panel, we can see that the commodity importers have been essentially having their economies perform essentially at their sustainable levels over the last 5, 6, 7 years, with the commodity exporters having had a significant decline as a result of the decline in commodity prices, now seeing that having sort of hit bottom in this particular cycle and now turning up. Nonetheless, growth is fairly near potential for the emerging markets and developing economies, according to our forecasts and statistics, and the slack in these economies is getting smaller. So, given the state of where we are there reasons for optimism? So, there are reasons for optimism in our view. And this slide looks at the period between 2016 and our projections for 2020 and compares that to the last 30 years. And we see that we are essentially, the world economy overall is essentially in line with average growth over the last 30-year period. Now, for the advanced economies, we're somewhat below where the growth was over the last 30 years. For the emerging market and developing economies, somewhat above. But overall, the global growth prospects look fairly strong for the world economy. And there are a number of reasons for this, in our view. One is elevated confidence. Another is the strong investment profile that we see, and another is the potential for growth spillovers from the advanced economies to the emerging markets. And so I'll touch on each one of these rather quickly. So, global confidence. So essentially now, according to the statistics that we're looking at, business confidence and consumer confidence are essentially at their highs in the post-crisis period. And then when we look at how this could affect growth going forward, our models show that for an impact of a unit of change in confidence on growth, our forecast going forward, there's quite a bit of momentum that comes from these confidence indicators when we model them from past performance into the future. And we see that all countries, both advanced and emerging market and developing countries, would see quite a significant impulse from these confidence indicators going forward into 4 quarters and even into 8 quarters. So this gives us some confidence about our forecasts. Then when we look at investment growth, when we see investment growth in emerging markets and developing economies, we see that the investment cycle is finally turning up in the emerging markets and developing economies. And this is an area that is particular of interest to the World Bank Group because, as you can see here, we have in the green line the 1990 to 2017 average. And there we've seen sort of underperformance in the recent year period. And this, of course, has a big impact on emerging market and developed economies' growth going forward, as well as employment and general stability of their economies. So this is an area of particular concern. But what we've seen here is that the investment cycle has finally turned up. And essentially this really is a result of the change in the position of the commodity exporters. This had been in a period of steep decline, and now with the turnaround in commodity export prices, we see that investment growth is now turning the corner and should have a very positive impact going forward, as well as we forecast continued investment growth in emerging markets going forward as well. So this is a very significant development. When we look at this right-hand panel where we see the per capita investment growth differential between emerging market and developing economies and advanced economies, we see that the 1990 to 2017 average, we've been below that for quite a period. We hit a 0 differential back in 2015, a very disturbing development. We are now seeing that also turning upward, and essentially that is the result of the increased investment we're seeing now from the commodity exporting countries. Turning now to growth in the G7 and the emerging market 7 economies. So these are the largest emerging market economies, which I could list if you're interested, but you probably know them yourselves. These are the largest economies in the emerging markets. So here we can see that there are high growth expectations going forward that we see here. So this is consensus forecasts of growth for the G7 and the emerging market 7 in 2018. And we see that this forecast is a very positive one. And when we look at how there has been a translation of forecasts of growth into actual growth going forward, when we model that relationship, we see that it has a very positive impact on growth going forward. So on global growth, and on the growth for other emerging market and developing economies. Again, we see this as a very positive impulse for how we are projecting growth going forward. So reasons for optimism in the relationship to the fact that in the past, high growth expectations have translated into sizable spillovers for the rest of the world in the coming quarters. So a big question then is, can this optimism be sustained? So when we've looked at that, we have at the World Bank, we have a macro financial risk index, and this looks at a variety of indicators over many countries, the many countries that are our member countries at the World Bank Group. And we look at indicators such as risks in the public sector, risks in macroeconomic factors, risks in household sectors, risks in the banking sector. I'm sure areas that you're very familiar with. And when we've looked back in the recent period that this index is covering, so if we look back to the 2014 period, we see a recent low in risk, so lower index, lower risks that are seen in the global economy. And we can see that here in the chart for 2014. Since then, we've seen risks escalate somewhat in the economies that we're covering. And the reason for that is fairly evident from the chart on the right, which is looking at the top 5 macro financial risks in our sub-indices. And the sub-indice that has seen a very steep increase will not come as a surprise to you. It's our monetary and financial risk conditions indicator, and that has shown a steep increase across a variety of countries. And the result is that that indicator on the monetary and financial risk conditions, as well as our public risk indicator, are the top 2 risks in this indice at the present time. And both have shown an increasing trend from the 2014 period to the present, and are also showing a fair degree of elevation. Now, when our economists at the World Bank Group look across the world, what do they see as pointing to the main risks to macro financial conditions across the global economy? And perhaps it won't come as too much of a surprise that they see trade and foreign investment flows as a key area of concern to them. They see the monetary and financial conditions resulting from the potential for normalization of interest rates going forward as a key issue as well. And as I've already indicated, the public sector, risks coming from the public sector are also a key concern. So I'll try and address these in one by one as I go forward. Before turning to each of these, though, I think I wanted to share this piece of data point that we have here. So as you can see, I think this paints a very clear picture that before periods of alarming economic stress in the global economy, and in especially advanced economies, as is put forward here, we see that there's oftentimes been very few countries that have actually, in the advanced economies, been in recession. And as you can see here at the present time, there are no advanced economies in recession, and that has not always been a positive sign. So that does give some indication that perhaps the global economy, may be reaching some kind of turning point. And some of the issues that we've been discussing during the course of this afternoon certainly can look to be some of the triggers that could make this slide more in line with past experience. So on that basis, I can turn to talk about trade wars. So this question is around what impact will trade wars have on the global economy over the next 3 to 4 years? Ooh, and everybody's already head there. So So I think an interesting observation from this is, oh no, now it's 2%. So 2% of people think it will have no impact. It was 0 there for a while. So I think it's an interesting conclusion that 68% think there'll be higher prices handed down to consumers, and almost 40%, now 40%, a reduction in exported products between major economies. Well, that leads me then to my next slide, which talks a little bit about trade wars and exports. And the first part of the slide looks at the share of global trade by the US and China as a percent of total world trade. And from this slide, you can see that certainly a global trade war that would involve the US and China would certainly have a big impact on the share of global trade, because China and the US, in terms of services of goods, of exports, services and goods of imports, certainly will have a big impact on global trade, as they represent about 20 to 25% of the share of global trade. Now, our economists at the World Bank Group have actually tried to model the costs of a global trade war. And there are some details on how they've tried to do that in this slide, but happy to provide some more detail on that if that's of interest to you. But the impact of this global trade war that they've modeled, and I'm sure there are other models that would come up with a different conclusion, but this one looks at the regional impact of global trade war. And I think it's very interesting, especially from someone working at the World Bank Group or someone like you who might be interested in developing economies and how they would fare, that the biggest impact would be on the poorest regions of the world. So here we see that sub-Saharan Africa, that's what SSA means in World Bank lingo. Sub-Saharan Africa would suffer the most, followed by the LAC region, which has already, as we've heard, gone through a period of difficulty and adjustment. The MENA region, of course, also one that has struggled greatly, including with political risk. The ECA region, the South Asia region, these regions would all suffer quite a bit more than actually the advanced economies. So some sobering conclusions coming from that modeling exercise. When we look at trade policy uncertainty and the spillovers, it's certainly the fact that the higher the uncertainty, there will be a more sizable adverse impact on the global economy. So this really looks not necessarily at what is actually happening in terms of trade policy, but rather trade policy uncertainty and how that in and of itself can feed through into lower growth estimates, both for the advanced economies and for the emerging market and developing economies. So in the way we've modeled this particular exercise, we've looked, as others had, at the trade policy uncertainty as it relates to looking at various publications and how much they are mentioning aspects of trade policy in their publications. And as you can see, this is reached in this particular indicator that we've looked at, practically a recent all-time high. And that in and of itself would potentially have a significant impact on growth in both the advanced economies and the emerging markets economies. So turning now to the normalization of monetary policy, of course, this has been a topic of discussion for some time now, and one that has always been anticipated with some trepidation in terms of how the normalization of monetary policy would feed through into global economy, whether this would be a smooth process or one that was a bumpy road or potentially worse than that. And here, when we look at financial market volatility, and here we're looking at this period from January to April, we can see that financial market volatility has been something that's been quite volatile over the last few months, and certainly elevated versus the median from 2000 to 2017. So this points to the prospect that a smooth transition or a transition that will be free of bumps will be difficult to achieve. And this middle panel here just looks also at the US yield curve and obviously shows that the overall yield curve has significantly shifted over this period of December 2015 to the present. And the question then arises, well, in what kind of environment is the shift in the yield curve taking place? Is this an environment that is prepared for a shift in the yield curve? And the next slide, at least, or not the next slide, the next panel here relates to debt in emerging market and developing economies. And there I think it's quite evident that there are substantial vulnerabilities for which it is not clear whether emerging market and developing economies are prepared for. So from the 2007 period to the 2017 period, we've seen that private non-financial sector debt has risen significantly, and that government debt has also risen significantly. So this is an area of vulnerability going forward. There's no question about that. And in this particular slide, as we have in the macro financial risk indicators that I was talking about earlier, highlighted that there is a concern about public sector. This particular slide, these figures come from the IMF. They do show that gross public debt has been rising. It has been rising across the global economy, across the major advanced economies, and also across the emerging market economies, generally speaking. So this is an unusual situation to have debt both rising, gross public debt rising as a percent of GDP in both the advanced economies and the emerging market economies. The other pairing, which is also worrying, is that private sector debt is also growing as well. And in the emerging market economies, corporate debt is recently hit, just a tad below 100% of GDP. So we have a synchronized increase of debt across the globe in terms of advanced and emerging market economies, as well as in both the corporate sector and the public sector. So this is an area where further attention would be benefiting our policymakers. So this poll is around policy. Which policy type could help the global economy most in 2018? Structural, fiscal, monetary and financial, or global? That's an excellent question. So global, structural, monetary and financial, and fiscal. So I think that's a very interesting result, quite a differentiation across in the room on which way to go on policy. Perhaps all of them are needed at this point. So before exactly turning to what policies could help, I just wanted to point out, to take a step back from the perhaps the cyclical upturn that we're seeing and some of the short-term movements that we've been talking about, and take a step back towards longer-term growth prospects. And this particular slide looks at the 5-year ahead forecast of output growth versus and also the 5-year forecast of investment growth. And here we can see a clear trend. And since I'm running out of time, I won't describe it. And here, though, is a slide that I would like to spend a little bit of time on, because this looks at the income catch-up of emerging market and developing economies. And I think what this shows that emerging market and developing economies, as well as the LIC economies, these are the lower income countries that get grants and very concessional financing from the World Bank Group overall. These economies are growing faster than the advanced economies, but the catch-up that's required for these economies to attain 2017 per capita U.S. Income levels is around 120%. 120 years, for the emerging market and developing countries, and for the LIC economies, these low-income countries, around 250 years. So the policy response that's required, well, I think it's policy response is needed across all of these factors. I think in particular productivity reforms in the advanced economies and in the emerging market and developing economies, greater attention to health and education outcomes, and this is an area that the World Bank Group overall will be highlighting in the coming months, moving because of the uncertainty around how the global labor market is going to be evolving over the next 10, 20, 30, 40 years. Our emphasis is going to be on increased health outcomes and increased education outcomes, because these, of course, will be needed no matter how the labor markets evolve over the next generations. So to answer the questions, how is the health of the global economy? Well, there's a robust expansion underway. Are there reasons for optimism? Yes, there are reasons for optimism. Can this optimism be sustained? Well, probably if there are the right policy responses, there is some degree of confidence that that growth could be sustained, but it will require a strong response to improve growth prospects. As we've seen, we're reaching potential, and proactive measures really to reduce vulnerabilities. Thank you.